Hi, in this video what I'm going to do is go through a silly example, but even though this is a silly story and a silly example, I want to make clear to you that this really does have a lot to do with how the money and banking system really was created and how it really works. So it's a silly kind of example about people living on an island, but follow along and there are a lot of important lessons for how banking systems really work. So I'm going to post this handout on my website at www.berkeyacademy.com and click on Files. And what I'll do is I'll save it there and I'll call it Bank Activity or something like that, .pdf, bankactivity.pdf. Okay, so there you go, bankactivity.pdf at www.berkeyacademy.com. So let's go through and do this real quickly here. Suppose we live on an island, and I'm your big chief, and our island is called Florin, for example. And suppose there are four families besides the big chief's family: Sunbeam the baker, Mr. Brown the wheat farmer, Ahab the fisherman, and Thor the hut builder. And whenever you have a primitive economy, you always start off with bartering. And bartering is whenever you trade one good for another. And one of the problems, there are a lot of problems with bartering. Number one, it's very hard to value things. Um, and you need a lot of prices. I'll put these two ideas together. Um, how can you tell, for example, how many fish a hut is worth? And then you also need to know how many fish a loaf of bread is worth, and how many pounds of wheat a loaf of bread is worth, and so on. Instead of just having one price per good, you'd need to be able to translate fish into bread, fish into wheat, fish into huts, and everything else. Another problem we talk about with bartering is a double coincidence of wants. For example, if I'm the fisherman and I want bread, it just has to be the case at the same time that the baker wants fish. Maybe the baker doesn't want any fish. Maybe the baker wants wheat and a house or something like that. So bartering can be very cumbersome and it inhibits trade. So usually something will evolve in an economy as being money. And things like shark's teeth, whale teeth, shells, gold, silver, cigarettes, all these things have been, yes, cigarettes at one point or another have been used as money. So in this silly example, let's suppose that we have trees on a mountain, and on this mountain, the trees so happen to produce Reese's peanut butter cups. And so it evolves that on our island we use those as money. Everybody likes them. They have value in themselves. And the fisherman, he used not to be able to save fish because they would go bad. But Reese's peanut butter cups, they stay good for a long time. So people start trading them back and forth, and you only need one price for each good. You know, for example, that it's 5 Reese's peanut butter cups to get a loaf of bread, or it's 2 for a pound of wheat, or it's 3 for a pound of fish, or it's 50 Reese's peanut butter cups to get a hut. So everybody trades in Reese's peanut butter cups. So we call this kind of idea commodity money. Reese's cups are just like gold, silver, jewels, or whale's teeth. They're things that have to be somewhat rare and have some kind of value in and of themselves because they're pretty or something like that. So question for you: why do coins have ridges on the edges or a raised lip around the edge? The reason is because people used to take gold or silver coins and they would file off the edges of the coins, and so they thought by putting a raised lip around the edge or little ridges around the edge of a coin, it would make it harder to shave extra gold or silver off the edge and debase the value of the coin. So let's go back up here and let's suppose that in our economy that we go and we take a census of how much money each person in the economy has. And we find that Sunbeam the baker has 10. of these Reese's Peanut Butter Cups. And the wheat farmer has 5. And Ahab the fisherman has 6. And Thor the hut builder, well, that's not staying on the screen for some reason. 6. Wheat farmer had 5. Um, well, it looks like my graphics is messing up here. You can probably see multiple of these things here. Let me erase just to clean that up a little bit. Um, and Thor the hut builder maybe has 20. He's a rich guy since he's a home builder. So when we're using this commodity money, we can easily count up how much money there is in the economy. And so 20 plus 10, 31 Reese's Peanut Butter Cups in the economy. And it's important to keep up with how much purchasing power there is in the economy. This is important for determining the price level and all sorts of things, how much trade could happen. So right now there's 31 Reese's Pieces in the economy. We might call this measure M1, how much currency there is in the economy. Now suppose in our simple story that El Nino causes a big heat wave on the island, and everyone's Reese's Peanut Butter Cups start melting. Also, everyone suspects Thor's son of breaking into people's huts and eating all their money. So, being the big chief, I have to come up with a solution to this. So suppose I have a basement in my hut that's cool and is always locked. And I offer to store everyone's Reese's Peanut Butter Cups for them in my basement, and they can come get them whenever they want to. At least between noon and 3 o'clock. I'm keeping banker's hours here. So everybody does this, but everybody might keep a few Reese's Peanut Butter Cups around just in case they can't get to my house before they need some money. But what I do is I give people receipts for their money, right? Because I need to know how many receipts, how many peanut butter cups I gave everybody. And so I might print up little individual pieces of paper that might look like this. So, little piece of paper that has 1 and then a picture of a little Reese's Peanut Butter Cup on it, and then I might sign it, Chief, here, right? So if I give everybody receipts for their cups so they know how many they gave me, they can come get them back. What usually starts happening in an economy is people store their gold or silver with somebody, and then they get receipts. Well, eventually what people discover is they can start using the receipts as money. Because if the receipts are just as good as the original money was, if they're good to be traded in for the original gold or silver or Reese's Peanut Butter Cups, then you might as well just trade those for products instead of going to get the gold and then trading it for a product, right? So a little story might happen. Mrs. Brown walks by Ahab's fish stand and remembers Mrs. Brown wanted him to pick up some fish. The chief is sleeping and he really doesn't want to come back later. So Brown says, "Look, Ahab, I don't have any Reese's Pieces on me or Reese's Peanut Butter Cups, but I do have some receipts. Will you take those?" And it seems reasonable that that would happen. Now, this actually did happen way back in history with goldsmiths. Goldsmiths had to have safes. They had to have security. So people would store their gold money with goldsmiths, and the goldsmiths would give out receipts. And people started using these receipts as money. And if you Google gold certificate, Google gold certificate, you will see certificates that people use as money. The United States government even used to print up silver certificates that were very similar to this. So we evolved from using commodity money to paper currency. When paper is used to represent the commodity, it's just the same as using the commodity, except we use these paper receipts instead. And I think China was the first country to use paper money in this way. So when we exchange the Reese's Peanut Butter Cups for the paper receipts, how much money do we have? Well, it hasn't changed. We still have the same amount, 31, that we used to have before. So there's no reason to think that this would really change anything substantial in our economy. Every once in a while, with banking, people want to exchange one form of money for another. So what would happen in this case if everybody got nervous and they wanted their Reese's peanut butter cups and they came back with these little pieces of paper that had pictures of Reese's peanut butter cups on them and were signed by the chief, and they all wanted to get their Reese's peanut butter cups back in reality? Could they? Could they still get them all back? For a real Reese's, this is my horrible artwork here. For a real Reese's peanut butter cup, the answer is yes. If you had a run on the bank and people went and wanted to trade their receipts in for the real peanut butter cups, they could. There would be no problem. So if everybody got nervous and wanted the Reese's back, no problem. They could get them back. But this is going to change in a minute, where a run on the bank will be a problem. Here's where this happens. Part 3. Ahab comes to the chief and says, I need a hut now, but I don't have enough money. Can you please loan me some? You have all those Reese's peanut butter cups sitting in your basement. Could I borrow some, go buy a hut, and I'll pay you back at the next full moon, for example? The chief says, well, you know, Ahab, you've been an honest guy for years. I trust you. I'll loan you some of these Reese's peanut butter cups. I'll loan you some of these original Reese's peanut butter cups here. Let me get you some, and you can use them. But wait, the chief says. Why don't I just give you some receipts instead? Right? We're a modern island. Might as well use the receipts. So the chief prints up some extra receipts, and he makes them a loan in terms of the receipts. I keep drawing them in different colors, but he just prints up a bunch of these. Let's say 20 of them. Or actually, on the next page, I have how many. So and here's chief. He prints up some more receipts. And the chief says, okay, here, take the 30 Reese's cups and pay me back by the full moon, or I'll have you killed. Or what could he do? He could print receipts, right? Receipts. And so suppose he does that. How much money is in the economy now? Well, there used to be $31 or Reese's cups flowing in the economy, but now what he's done is he's printed 30 more receipts. So now there's 61 receipts. And this is the key to understanding what happens with banks in the economy. When a bank makes a loan, it means there really is more money in the economy. There were 31 pieces of paper that represented Reese's peanut butter cups, but now there's 61. As soon as a bank makes a loan, it expands the amount of money. And it doesn't matter how the bank does it. Even if the chief handed out 30 peanut butter cups from the vault, still there would be those 30 peanut butter cups plus the 31 receipts out there. There's more money flowing around. There's more money, no matter how you chop it. When loans are paid off, the money disappears. This is an important concept. So what's going to happen when Ahab pays the 30 receipts back to the chief? Well, assuming the chief just throws the receipts in a corner or burns them, the money disappears. So making loans creates money, paying off loans destroys money. It's a weird concept, but it's true. What would happen if there's a run on the bank? What if everybody wanted their real peanut butter cups back now when there are 61 in the economy? Well, there's a problem. This is the point where when you try to convert one form of money into another, you can't do it, because there's more of one kind, the paper kind, than the real kind, the peanut butter cups, right? So a run on the bank would mean that a bank would have to shut down and close its doors because the chief does not have the kind of money they want, the Reese's peanut butter cups, in exchange for the paper. Okay, now suppose, here's another part of the story. Suppose the chief wakes up at noon and he wants a snack. Then he just decides to eat all those Reese's peanut butter cups because they've been sitting there for years. So he eats them all. What happens when there's a run on the bank now? Well, there are no peanut butter cups, and so we have transitioned from having just paper currency to what we call fiat or fiduciary money. This is the kind of money that every country has now. I don't know of any country where the currency actually stands for anything. It's not backed by gold, it's not backed by silver. Now, back in the early 1900s, currency was backed, and even to the mid to late 1900s, currency was backed by gold at some level or another. But now we have fiat money. Now, fiat money just means money has value because of a governmental decree. The government says it's worth something, therefore it's worth something. But they don't tell you exactly what it's worth. It's worth whatever someone will give you for it. So $1 in the U.S. is worth about a hamburger because you can get a hamburger for $1. Okay, step 3, part 5. This fiat money's cool, the big chief thinks. I'll print up a bunch and spend it. I'll create a lot of wealth this way. What are the problems with that? Well, we get into the problem that can be explored using the equation of exchange. The equation of exchange says the amount of money times V, M is the amount of money, times V, the velocity, how many times the money spent, has to be equal to the average price of everything times the quantity of things. Simple example. Suppose there was $100 bills in the economy. Sorry, my pen is going crazy here. I think I'm stretching my computer past its limit with the length of this video. I apologize. It's an inexpensive one. Suppose there were $100 in the economy. I'm going to have to end this video here and restart the computer, and I'll come back with a second half. Okay, I think I got my computer straightened out here, so let me continue where I had left off here, but trying to explain the equation of exchange here. So the equation of exchange, MV equals PQ, let me choose a different color here, says that M, the amount of money in circulation, times V, the number of times it is spent on average per year, velocity, it must be equal to the average price level P times Q, the number of objects produced and sold in an economy. And so, again, trying to use simple numbers here, if there are $100 in an economy, or 100 billion, and each of those are spent an average of twice per year, which is roughly on average about where we're at in the United States these days. Each dollar of, I believe, M2, which is savings account money and checking account money and currency, spent about twice each year, equals the average price level. So let's suppose that on average the price of things in an economy is 10. Then that means that Q must be the number that makes the right side equal to 200, right? So this is saying the amount spent, $100 twice, must be equal to the amount of things bought, or the monetary value of things bought. $10 times 20 things must be it. 200 equals 200. What happens, and this has been the cause of hyperinflation in every case historically, is whenever the amount of money increases. And so whenever a government decides to print money to spend it, they increase the amount of the money supply too much. So suppose they increase the amount of money to $200. Suppose it is still spent twice. Well, then that means that the total amount being spent is now 400, 200 times 2. And that has to be equal to the value of the things bought, the average price times the quantity of things bought. What we normally observe is there's no reason to imagine that more things will be produced to be sold in an economy, so that's still probably going to be 20. The thing that's most likely to change here is the average price of the things sold. And so if you double the amount of money in an economy, what's probably going to happen is that the prices are going to double. So this is what happened in Germany and in Zimbabwe and in Yugoslavia. The government decided to start printing money to spend. So this is a very simple equation, the equation of exchange, to demonstrate that idea. So, uh, next idea to talk about in the evolution of a monetary system is checking accounts. And checking accounts are basically the idea that whenever you have a banking system and people have accounts in the bank, then instead of having to go to the bank to withdraw money to go spend it, it's just as easy, or most times easier, to give people a piece of paper that they can take to the bank and get money out of your account. Or, even easier than that, an order to move money between two accounts. And we call those things checks. And so you can imagine a story. The receipts, the paper money might start to fall apart or get lost. Why would you want to carry the money around all the time? Just, if as long as you trust the bank, let them keep a record of how much money you have in the account. Or they used to have little passbooks where the bank would stamp how much money you have in your account whenever you make a transaction. So the chief comes up with a new scheme. How about you bring your receipts back to me, and I'll just keep a log of how much money people have. So these are savings accounts or checking accounts, and I'll just keep these paper receipts in my basement because we don't really need them anymore. And that's really what we see in modern economies now. People don't carry much cash. They just rely on checks or debit cards. So if you want to buy something, just write this down on a piece of paper. And this is really what a check is. It's not a special piece of paper. Legally, you can write a check on any old piece of paper, even a napkin, as long as it has your name, your account number, and this kind of phrase. Your name, pay to the order of the other person's name, the amount of, write down the amount, and then sign it. And as long as they take that to the bank, that's a legal check. So this is what we call a checkable deposit these days. You deposit the money, but you can write a check to transfer funds from yourself to someone else. Now, let's think about this idea of a run on the bank. Now, what does a run on the bank mean? Well, now a run on the bank is not people running to the bank to get gold. A run on the bank is now when people start to panic that the bank might have done something with their cash, and people run to the bank wanting their pieces of paper back. It's a very interesting concept, but a run on a bank is just when people get nervous and they want to exchange one form of money for another. And so in this case, it's the idea that people want to exchange nothing, or accounts, deposit accounts, for paper. And this is what people in Cyprus want to do now. People don't trust, and this is 2013, people in Cyprus are facing their government possibly taking, sorry, my computer is acting up a little bit here today. People in Cyprus are wanting to get cash out of the bank in exchange for nothing, just electronic accounts. So a run on the bank is just exchanging money of one form for money of another. Another thought question: what would happen if the chief burns all of this money, all of these paper receipts? Well, again, that's the case in the United States and in most modern countries. The money that's in your account does not sit in the bank. When you deposit, even if you did originally deposit cash, pieces of paper, that bank doesn't keep the cash there. They loan it out. But they don't loan the pieces of paper. They don't loan cash. Whenever you get a loan to buy a car, they write a check, or they just deposit electronic, funds in your account. So most money in the world does not exist as gold. None exists as gold now. And most of it doesn't exist as pieces of paper. Almost all of the money in existence in the world are just numbers in accounts. They only exist electronically. And this is a very weird idea when you first hear it, but it's the honest truth. Let's think about how the big chief could make loans now. The big chief does not have to give out pieces of money for loans. He could write a check for a loan,
Or if he wants to give you a loan, all he really has to do is go into his computer or his logbook and write down a higher number in your account. So that's how he can create money. He can just go into your account and write down a bigger number. Just write it down. That's how you can create money. And this is indeed how the central banks in countries create money now. All they do is go into an account and type a higher number in it. That's all it takes to print to create. We say print money, but we just mean create more money. Where is the money? Well, most money just exists as numbers in a computer somewhere. There's no paper, there's no gold, there's no nothing. And money has value simply because people trust that it has value. I accept money from you because I know that the next person will accept it, and it works fine. Um, Suppose I want to increase the amount of money in the economy. The big chief could just go out and buy anything he wanted. He could go buy a hut, he could buy a car, he could hire an assistant, and to create the money to do that, all he would have to do is write down money in someone's account. And that's really how they do it though. How could we decrease the amount of money? Well, the best way to decrease the amount of money is for a bank to sell something. So, for example, if a bank wanted to decrease the amount of money in an economy, suppose they had some gold in the safe. So suppose they had some big gold coins in the safe. All they would need to do is sell those. So they give the coins to a person, and then the person gives them money to the bank. So I'll put dollar signs here, but you get the idea. Um, and so this is how the Federal Reserve and how central banks do this. They create money by buying things and exchanging the things for money. They decrease the amount of money in an economy by selling things or selling the same things back. The things go out, the money comes into the central bank, and then they destroy it, either just by deleting the numbers in a computer, or if you want to think about paper money, they could burn the paper money, or just bury the paper money, or lock it away in a safe somewhere. But most of this is just done electronically these days. One last thought question about money is suppose I have a credit card in one hand and a debit card or ATM card in the other. If I walk up to an ATM machine and put my ATM card in to get $20, how is it different from if I put my credit card in and get $20? The answer is, the big difference is with the ATM card, you haven't really changed the amount of money in the economy. All you have done is taken $20 that was inside your bank account as a number, right, in your bank account, and you have converted it into a different form of $20, which was a $20 bill. So the amount of money in the economy has stayed the same, it's just changed from one form to the other. When you put your credit card into an ATM, though, something different happens. It seems like it might be the same thing, but it's actually a very different idea. When you put in that credit card, you take money that doesn't really exist. Now, by that I mean the bank has the money, certainly, but where did they get that money? Well, that money is in someone's account, right? The bank itself, the central bank of a country can create the money, but the bank has to have the money somewhere. Maybe it's from a depositor. This is someone else's account. They have $20 in it, and the bank wants to loan that money out. Well, they could loan that money for somebody to buy a house or a car, but a credit card is a loan. So when you get the money on the credit card, they are creating a loan of $20 to you. And my claim is, as we talked about earlier, anytime you make a loan, you create money that didn't exist. Now, how is that working in this case? Well, how this is working in this specific case is the person whose account this is, they still have that $20. They still have that $20 of purchasing power that the bank owes them They're not using it right now. It's sitting in the bank, and the bank is free to loan that out. And by creating the loan, now you have $20, right? You have $20 worth of money. Plus, this other guy also still has that $20 in his account. Now, he can't really get at it right now, right? This gets back to the idea of a run on a bank. If everybody who has an account tries to go and get that money out of their account all at the same time, they can't. But banks trust that that's not going to happen. Banks do always keep some cash on hand in the vault for transactions because some people will be taking money out and some people will be putting it in. There's always this constant cycle in and out. But in terms of purchasing power, the person still has the $20 in the account that they could spend, and you have $20 that you just borrowed on your credit card that you can spend too. And so this just reinforces this principle that anytime a bank makes a loan, they create new money that was never there before. A weird thought, but a very true thought. And we're going to look at some other examples of this later on when I make some more videos about the Federal Reserve System or the central banking system and how they do that. But basically, they create money in a similar way, but there are a few other little details involved.